Are you in the Elizabeth Warren camp now? Is that what we're going to call it?
Well, let's take a different view here for a second, and it kind of is, where are we? And I will say, Kelly, we tend to not repeat the mistakes of our parents. We repeat the mistakes of our grandparents, and not looking back. And so here's what I'd ask you to look at. Is this inflation that we're looking at today, is this 70s-like inflation, or is this inflation that occurred like right after World War II? And let me remind you that right after World War II, inflation went from 2% to almost 14%, right back to 2% in 46, 47. And what happened was that we came out of a war, huge expansion of the money supply, and a reopening of the economy. Look, COVID, we spent as much as we did in World War II. We reopened the economy. Inflation really spikes, and I suspect that this is more like 46 than it is the 70s. And that's the perspective that I bring to this.
I think it's a really interesting one, and we've heard the analogy to the 40s and how that could be relevant. I guess the key question to ask would be, how did inflation fall that quickly? And what was it in the 60s and 70s that didn't work? Because back then they also thought the increase in inflation was a one-off, and we had a couple recessions and it still didn't go away and it kept getting worse. And there are some similarities to the redistribution effects that we saw after the Great Society in the 70s and what we've witnessed with the redistribution of the stimulus today.
Well, in the 70s, the economy was much more closed, a lot more regulation, a lot more entrenchment of labor and CPI increases. And inflation was a lot different in the 70s than we're looking at today. What happened, again, after the war, and again, we've just had a war with COVID, it was the confluence of a huge expansion of the money supply with a reopening of the economy. I think they're very, very similar in terms of circumstances, and that therefore I would say that inflation is going to come down a lot faster than what people would think of it being entrenched. And that's something that we have to think about, Kelly, especially with what the Fed's thinking about.
Let's maybe use Stifel as an example. How much is comp up year on year, and how much do you expect it to keep growing? Or are you guys going to shift into sort of hiring freeze or even layoff mode?
Well, I don't think we've ever had a layoff in my 26 years here. We're a growth company, and we're always growing. So I don't think that way. Even though we've been through a very difficult market here in the first 6 months, we're growing, and our comp is very variable. But as a base case, we raised comp, up 4%. On base salaries, and that needed to be done. We'd had a suppression of wages because of low inflation. I don't view that as some, base that inflation's going to be, climbing 8 or 9%. I think that inflation is going to come back down. And let's talk about the Fed. The Fed's going to raise 75 basis points. Back last time I talked to you, I said they should be slow.
Yeah.
I think what they need to do is look now at where the terminal rate should be. The market thinks the terminal rate should be 3.35 at the end of the year. Look, Kelly, the 30 years at 3%, the 10 years at 2.77. I personally think the Fed has to raise rates. But when that last 25 basis points in December, which is what the market's thinking, 50, 25, 25, I think that last 25 could be on the table not to happen.
Oh, sure.
You get to 3%. We shouldn't be pushing it, should be much more data dependent.
We're still talking about a doubling of rates from here, and the pace of quantitative tightening picking up considerably. So there's a lot that's still coming down the pike.
Shepard Smith here. Thanks for watching CNBC on YouTube.